But let's welcome on board S. Krishna Kumar and get a sense of what he's making of the market right now. KK, hi, good morning. Good to have you on the show. Just figuring out, trying to make sense of what really is the market mood, which really seems at least, completely somber. Combination of the FPI surcharge, the kind of exodus that we've seen from the foreign money, and of course the economic slowdown all playing out. What should an investor do?
I think over the last few quarters we've been going through a lot of news flow in terms of the degrowth in auto sector. The housing has been also pretty slow. So I think these are two big parts of the economy, and that's what is hurting. At the same time, I think, like you mentioned, some of the proposals in the budget are not being taken well. So at this point in time, what we are seeing is that the government also seems to be quite concerned and acting. I think we do expect a lot more measures to come through over the next week or so, which will provide a bit of more fiscal stimulus, and also from the RBI side, I think we are seeing more action coming through. The budget proposal is now being implemented through the circular that we came out yesterday. So NBFCs definitely have a window of liquidity coming in. And this broadly covers most of the NBFCs which we are worried about. So I think that's a very positive sign at this point in time. If you look at valuations are quite comfortable, broad markets and also Nifty, and the relative discount of mid caps to the large cap indices, etc. So I think there is definitely good comfort there. Also, if you keep tracking the earnings yield gap between the 10-year GSEC and the equities, I think this is moving to a territory closer to zero or negative in the case of mid caps to the GSEC yields. So typically in the past, you've seen that yield gaps closer to zero do tend to have a period of next 3 years when equities outperform by about 50% kind of over a 3-year period. You might still go through a time consolidation, but I think broadly you are around the bottom when you have the earnings yield gap closing, and we are nearly there at this point in time. So we remain optimistic that.
KK, I mean, again with the caveat that we both are optimistic, and we both have seen these cycles. But what I've not seen in the previous cycle is that you have a situation where the sound bites which we are getting from risk takers, which are entrepreneurs in the economy, is not that convincing. I mean, economies, they go up and down, and entrepreneurs, they always take risk. But right now, the unfortunate sense I'm getting from at least the big corporates, the risk takers, is that we don't want to invest. We don't feel safe to invest. If we invest, we don't get good post-tax returns. Banks are not giving us money. This is not a good environment where you may make your view for an economic recovery. The point I'm trying to say is that nobody wants to invest. If nobody wants to invest, what will happen to economic recovery?
So a couple of things here. I think, definitely the way of doing business has changed over the last 5 years. So, you have the IBC Act and a lot of other things which have come through. So definitely, guys, who have, been, probably, erring on the wrong side have been finding it tough. The second point, more on the listed entities and corporates, with credibility. I think definitely, the industry is trying to put a lot of pressure on the government to give them SOPs. I think that's the thing. That's the only way that you put pressure on the government, right? You do talk negative. You say there are layoffs that's happening in your factories, and you say the bank credit is not available. So that's the way markets and corporates put pressure on the government to act and the policymakers to act. So I think that's clearly happened in the last 2-3 months. And take the example of auto sector, the housing sector. I think these sectors, the corporates there have made a point to the government that things are not easy, and you need more space and incentives going forward. So and a rollback of few of the measures taken, which are probably hurting them. So the government, in its own wisdom, I guess in the last 1 week has its own discussions, and we expect some relief to come through. That's what we believe. will change the environment also. But when you talk about domestic corporates, but also look at the FDI that you've been getting, look at the kind of buyouts that PE funds are making, and the other big investments that MNCs have made in the country, and they are increasingly also putting more money to work on the ground. You have a lot of auto companies setting up shop here when domestic auto guys are worried about growth, right? So I think there's a disconnect between what the foreigners are seeing in India from a long-term perspective and what Indian corporates are looking at. So I think it's more a pressure tactics from the corporates to push the government to give them more space.
How are you currently finding value in this market? What is the criteria where there is value in the market? Are you buying value? Are you hunting for value in industrials and cyclicals, or you think that one has to now revisit consumption because that is the only engine where there is hope of recovery?
Yeah. So, if you look at the consumer discretionary part, it's also cyclical, as you have seen. So, I think a little bit of, cyclicality is playing out there in terms of the auto side, definitely. And if you look at the low-ticket consumer discretionary items like durables and white goods, brown goods, I think things have been pretty much okay, but a mild slowdown there. So, we think that, the stocks have gone through a huge time consolidation. Valuations are getting far more reasonable and attractive to kind of look at it from a 3-year perspective. So we are definitely adding up consumer discretionary as we speak, and also on the other pillar in terms of investment cycle, definitely it's an underinvested space, and we do find that in the next 2 years there will be a lot more positive news flow coming in terms of the order book improvement and also the investment cycle picking up. Definitely the government is doing its bit. The first 3-4 months have been slow because of the government coming in, but I think in the rest of the year we see accelerated government spending on infra, and that will push further private sector also to kind of relook at their own plans in terms of capex for the next year. So I think a combination of industrials and cyclicals and the consumer discretionary is what we are positive on and adding to the portfolios.
The auto sector, really, the slowdown is only deepening here now with sales coming in at a 2-decade low. It seems like even the timing of the slowdown at a time when a lot of these auto giants are struggling with shifting to these new emission norms, new safety norms, really seems to be all piling up at a bad juncture. So what does this spell for the auto space? Because you seem to believe that in the long haul, there is potential.
The automobile sector is in a bit of a spot because of the incremental cost on BS6 transition, which are different for different sectors basically. However, I think given the stiff cost hikes that could happen in commercial vehicles and in two-wheelers, I think these are two areas where there could be good amount of pre-buying that will happen from now to the fourth quarter. Not to forget, there's the bodybuilding also that needs to be done on the commercial vehicle before to register. So you will have a lot of upbeat in commercial vehicle sales in the next 4 months is what I believe, and then it could kind of normalize. Passenger cars, however, are going to go through a little bit of slow growth into the next 6 months. As people move the festive season, there will be some bit of recovery, and the NBFC funding is also getting better with some of the measures taken. So that will give them a bit of a boost. The second half, the overall year could be more closer to 0 to -5%. However, I think into the FY21, I think we will have to revisit. The rains have been good. The agriculture space is going to do better. Freight availability is going to be better. So I think there could be some more prosperity from the rural side that could kick in for two-wheeler sales and low-end automobile passenger car sales also in the next 1 year. So we believe that auto sector could be a little bit more of a soft story for the next 6 to 12 months, but we would probably look at the space in a little while later.
Right. KK, so from August to, let's say, end of the financial year, are we in for a flat market? Are we in for a volatile market? Or now markets are fundamentally oversold and we are in a value zone, and a double-digit gain from here to year end, which is about 8-9 months, cannot be ruled out?
I would I would at this point in time be more positive on the markets. As you mentioned, I think we've had a good amount of volatility, a lot of correction, and definitely, the froth is completely out of the market. Even whatever the flows came in the last few months, I think a lot of that from the foreigners has gone away, which is more event-led money. So at this point in time, if we look at the current macro framework, we would probably believe that the valuations are quite supportive, and any improvement in data that we see over the next 3 to 6 months would result in a positive move on the markets. Given the kind of 15 to 16% growth that definitely looks on the cards for FY 20 and 21 on the Nifty earnings and the broader market earnings also around those levels. I think we definitely can hope for a positive close from here to the end of the year.
Okay, thanks much for taking time out and joining in, giving us your overall outlook on the markets as well as individual sectors.